Hello chart watchers, 2018 is drawing to an end and it's time to look back. Time to look back at a number of headlines, especially the ones, for me at least, that mention sector rotation, because I think that was one of the big themes of 2018. From my own work in the RRG blog, the headline that I want to talk about today is the one of the 24th of July. And that headline said, relative rotation graph showing strong rotation from energy to staples. At that time, in the middle of the summer, the consumer staples sector year to date had the weakest return of all sectors in the S&P 500. It was down about 5.5%. When we look at relative terms over the same period, it's even worse. The staples sector was underperforming the S&P 500 by 12%. Why did I write that headline? It all started with this RRG when I opened it up. And it was especially the length of the two tails for those two sectors that drew my attention. On the right hand side we had the energy sector that just came out of leading, moved into weakening and was starting to head over to the lagging quadrant. On the other side we had the consumer staples sector that was inside lagging, improving, went into the improving quadrant and started to head over to the leading quadrant to the right. But it was especially the length of the tails that made this rotation stand out as it was. And as you can see, it was about 8 weeks before the peak in the S&P 500 occurred. If we, in hindsight, look at what happened after that block, and these tails start on the 24th of July and they end on the 17th of December, which is today. You can see that the staples sector is now way up to the right inside the leading quadrant, while the energy sector is way down to the left in the lagging quadrant. Shortly after the rotation of energy and staples, they were followed by healthcare in a positive way and technology in a more negative way. But as you can see, the staples energy rotation was further to the outside, so therefore more powerful than the healthcare technology rotation. The one thing that we have to address is that strange move in the staples rotation which occurred while it was inside the improving quadrant but hooking up while it was going down. And you probably have seen it before, but that is, if you plot it on a daily chart, a very rapid rotation across the axis before it started to go in sync with the weekly again. All in all, these rotations were remarkably accurate in the risk-off scenario that we've been predicting, and it was way before the S&P 500 started to deteriorate. So relative rotation graphs under the hood started to signal weakness in the overall market. And if we look at a 21 period from the 24th of July onwards, we see that staples were outperforming energy by about a whopping 20%. For me, that's good enough to continue studying RRGs going into 2019. And I wish all of you very happy holidays from Amsterdam and see you all again next year.
Hey, this is Arthur Hill, host of On Trend. And in 2018, I noticed a breakdown in the semiconductor group that I want to highlight. So the reason I want to highlight semiconductors is because they are a global industry and they are very sensitive to the global economy. If the economy around the world is going to be strong, semiconductors should be strong. And if there's going to be some weakness, they may get hit. So here's some international index charts, and we can see the German DAX has been moving lower all year long, as has the Shanghai Composite. And there you can see the South Korean Kospi has been moving lower. The S&P 500 turned lower in September, October, November, and December, as did the Nikkei. So they are starting to weaken, and all of them are below their 40-week moving averages. Now here is the semiconductor SPDR XSD, and you can see from the holdings over here, it's more equally weighted. It's not so weighted towards large caps, but it is showing a lot of weakness. And what I am noticing here of concern is we had a 52-week high there, and then a mere 8 weeks later, we get a 52-week low. So this is an abrupt reversal of the uptrend. We went from basically a strong uptrend to a downtrend with that breakdown there. So there you can see a support break and a 52-week low, and that is bearish for semiconductors. If we see a pattern at work here, I could see something like a rising wedge here, and we're broken the boundary but trying to firm up here. But right now I would be more bearish on this and expect to move lower. And as with the SOX index, I would like to see a move back above that breakout zone and say a move above 73 to put this back on the bullish track. Otherwise, I am still bearish. So to recap, I view the breakdown in semiconductors as a bearish event that we need to monitor in 2019.
Here is the most important thing that happened in 2018 from a Wyckofian perspective. Here you're looking at a chart that was posted initially in March of 2018 in the Wyckoff Power Charting blog. This is a dramatic uptrend that occurred in 2017, accelerated in January of 2018 into a buying climax, which failed thereafter. Notice this huge change of character, high spread, large volume, big change of character. We would conclude after that we are in a range-bound condition for some period of time into the future. And so we have a chart here through March, but let's go forward and look at the year. On a weekly chart, you can see the accelerating conditions, buying climax, resistance, automatic reaction, support, up thrust in September, October, which fails, huge spread, wide volume, both in January, February, and in October, November, shows there's a lot of supply available. This has all got to be worked off before the market can rally again. Here we are, this gray dotted line is the lowest weekly close of the year, which occurred in March. We are right there now. Stabilizing and rallying would be a good thing. Continuing to fall through support would be a problem. So here is a point and figure chart, 2015, 2016. This is a horizontal accumulation area. Notice this beautiful big rally is signaled off of that count. 2960, 3140 is the range. We got within one box of the lower count of the range. Pretty impressive. And we are range bound for some period of time, building potentially a new count for another move. We will keep watching and see what happens in the future. Join us, stay tuned, and thank you for tuning in now.
This is Dave Keller, and if 2017 was the rise of Bitcoin, 2018 was certainly the fall of Bitcoin. Bitcoin over the last 2 years has been a textbook example of the bubble phenomenon and the rise of an asset to euphoric levels where people speculate on how it will never go down again. In late 2017, we had on social media the phrase "when Lambo" became popular, as in when should I sell a little bit of my Bitcoin investment and buy a new Lamborghini? And when that comes out, folks, on a market that you're looking at, you should be wary of a potential speculative bubble. What happened in 2018 is we had a complete reversal, and for me, this was a reminder to go back to the fundamentals of the technical toolkit. We went from a Dow theory uptrend of higher highs and higher lows to a Dow theory downtrend of lower lows and lower highs. Now, while this chart looks incredibly orderly uptrend and downtrend, I will tell you in the heat of the moment, this did not feel anywhere near orderly. And these moves, which seem very brief on the chart, are actually 20-30% corrections during this uptrend, and also 40-50% rallies, during the downtrend. So I think why Bitcoin's rise and fall, and especially the downtrend we've had in 2018, why it's so important is for two reasons. Number one, it's a reminder that bubbles will continue to happen as long as markets are continuing to be driven by human behavior, which I think will be the case for the foreseeable future. So bubbles are a thing; they will continue to be a thing. There will be another bubble in the next number of years, and we will look back at this as an example of how to think about it. And the second reason why I think this is important is it's a reminder to focus on the core of the technical toolkit. So just looking at the RSI indicator here on the middle panel, you can see what the RSI looks like during a bull phase, where it ranges between 40 and maybe 80 or 90, and then what it looks like in a bear phase when it fluctuates from maybe 20 to 30 up to 60 at the most. And this transition from bull phase to bear phase is what now seems very, very clear. In the heat, you have to pay attention. In the heat of the moment, you have to pay attention to these fluctuations. And this reminds me, looking at the bottoms in the RSI and how that coincides with the bottoms in the price, and the same with the peaks and the rallies in the RSI. It's a reminder to just come back to the basics. It's often been said, never confuse the bottom of the page with support, and that was something with 2018 and Bitcoin we had to remember. So Bitcoin came down and then it kept going down, and just because it gets to the bottom of your screen does not mean it can't continue to go much, much further. What's interesting now here in mid-December of 2018 is we have a bullish divergence of lower lows in the Bitcoin price and higher lows in the RSI. For me, that tells me I want to be wary of a potential rally here after it's come down so much. It's worth noting that even after the incredible sell-off in Bitcoin, down over 70% year to date in 2018, it still outperformed the S&P 500 in the last 2 years. It's up about 288%.
It would be hard to talk about the influential events of 2018 without including the rise and demise of the FANG stocks. For those unfamiliar with the acronym, it embodies all of those high-growth, large market cap stocks in the technology sector. F for Facebook, the two A's are Amazon and Apple, N is Netflix, and finally G is Google. These are the stocks that are continually in the news and have been the leaders of the market. I mean, think about it. The FANG stocks make up 40% of the NASDAQ and 12.8% of the S&P 500. You know, the story doesn't actually begin in 2018 because in 2017, Facebook, Google, and its cousin Twitter started to take hits with investors over the probe of the misuse of user data and censorship. And once investors lose trust in your company, it is very hard to bring it back. Facebook did manage to hit an all-time high with a gain of 20% in July of 2018, but it looks to finish the year in the red, down more than 20%. Apple was the first U.S. publicly traded company to hit the $1 trillion market cap in August, and Amazon followed suit in September. I think Amazon's probably the strongest of all. It looks like it's going to end the year up nearly 30%. Amazon is perpetually in the news. They have their fingers in everything. I suspect they're going to be one of the stronger ones heading into the new year. Netflix navigated some rough waters more easily than its brethren. Despite worrying investors in that mid-year report that they were short on subscriber growth, Netflix hit the accelerator and hit its all-time high of $418.65 in mid-July. That was about a 108% gain since January to that all-time high. However, after the correction began in October, and as of this taping, it looks like it's only going to finish the year with a 31% gain. Not too bad, but that's a lot of shaved profit. So, let's go ahead and look at that perf chart. Because I think it's really clear the winners were Netflix and Amazon. You can see those excellent gains. The worst performer clearly was Facebook, down nearly 25%. Apple and Google hit their all-time highs in September, but they're gonna end up finishing the year likely with some losses, or maybe just a little bit ahead, depending on what the S&P 500 does, I suspect. So we saw all-time highs and $1 trillion market caps in 2018, but with the ushering in of what looks to be a bear market, these stocks lost billions in value. Estimates were that Apple lost $231 billion, Amazon $220 billion, Google $138 billion, Facebook $90 billion, and Netflix $48 billion. And when you add that up, that's more than $728 billion. And guess what? That was just since October 3rd to late November. And I've heard estimates that we actually, value has been demoted to $1 trillion for these FANG stocks. So, perhaps investors are finally starting to doubt whether these stocks can hold their value, and certainly they can't keep going straight up. Rising interest rates, the rising dollar, of course, the uncertainty of the trade war with China, all of these could deeply affect the bottom line for these stocks. So stay tuned, and StockCharts will be keeping you up to date.
Hi, this is Dan Russo, Chief Market Strategist at Chaikin Analytics and host of the Stock Market Today show on StockCharts TV. And to me, one of the most important events technically for the market in 2018 was the halting of the uptrend and then breakdown of semiconductors relative to the S&P 500. And what we're looking at here on this chart is the SMH relative to the SPY, so the Van Eck Vectors Semiconductors ETF relative to the S&P 500. And you can see that that relationship was in a steady uptrend, which began in the late summer, early fall 2015 and continued until early 2018, at which point that ratio began to roll over. It cut below the 200-day moving average and then took out a key support level. Why I think this is important is because this ratio tends to lead the broader market. As we can see, this ratio made its low in 2015 ahead of the S&P 500, which made its low in early 2016. Then a nice steady uptrend ensued for both the semis relative to the S&P 500 as well as the S&P 500. And then the ratio of semis to the broader market went into a trading range, which preceded the January sell-off for the S&P 500. And it continued to trade sideways even as the market rallied higher, but did not confirm the September highs for the S&P 500. And has now rolled over. And the reason I think this is important is because semiconductors are prolific throughout the economy. They are in just about every device that we use on a daily basis. And I'm not just talking about our smartphones and tablets. I am talking about our cars, our appliances, and a plethora of other items that I can think of. So to the extent that semiconductors are weak relative to the market may have a hard time rallying to new highs.
Hi, it's Mary Ellen McGonigal, and I'd like to share with you a very impactful event that helped shape a good part of the trading action in the broader markets for 2018, and that is the late December 2017 signing of one of the most sweeping tax legislation in over 30 years. This is the Tax Cuts and Jobs Bill, which reduced corporate tax rates from a high of 35% down to 21%, and the impact was quite heavy. We can see the exuberance following the signing into passage of this law going into the beginning of 2018. And then, of course, we did have a correction, presumably from this overexuberance. But we can take a look at the reversal out of this correction, and it's just in time for the reporting of Q1 earnings at the end of April, with over a third of the S&P 500 having reported their earnings. The results were in. In a report from Bloomberg, almost $13 billion in taxes was saved, with the income boosting these corporations' earnings per share. We can see the continued advance at least into the beginning of October, again driven primarily by strong earnings that are subsequent to this sweeping tax legislation. As far as those areas that benefited the most, it was companies that went into 2018 with already strong earnings and prospects for growth being strong, simply because their profits were that which benefited the most from these tax cuts. A primary example would be the technology software ETF, and we can see that in 2017, this area had a 34% year-over-year earnings growth going into this tax cut, and in fact the outlook was quite strong for this group going into 2018, but the tax reform benefited them even more. Some of the sub-industry groupings within software were up over 40% prior to this correction in October. Other areas that benefited quite strongly were those companies that spend quite a bit on capital equipment, and this is because they got what's called a double shot of gains. In addition to benefiting from the tax cuts, they also had a lot of deferred tax liabilities that they can set aside for the future while locking in current low tax rates. This is a prime example. CSX Corp, a major rail stock, we can see the nice uptrend this stock experienced. And then other areas were telecommunications with their big spending on wireless networks, internet data pipes, and so forth. They also took advantage of those deferred tax liabilities. We can see this nice advance in Verizon Communications, a major telecom player, again going into this October correction. And while certainly there were quite a bit of other areas that impacted the market as far as headline news driving action, I would tell you that the broad market rally from May through September was driven primarily by the tax cut and jobs bill that took place for 2018.
Lots of things have happened in the oil market. Obviously, this year it's been a rough one, especially to wrap up. First of all, covering off the big picture on oil, what we see here is these are annual candles, and we had built this big topping structure, and we currently appear to be in the right shoulder of that, which is a bit of a concern because oil demand is helpful to help to see in terms of overall economic activity. I'll show you that on the next chart. The bottom line is we've had quite a few endings of the year around $55. It's been kind of an area of activity. We've clearly plunged through that. Now we're closer to 46, and so the next meaningful level of support is down in the low 40s. And I would say that, you know, we had a couple of year ends right in there. So namely 03, 04, 07, 08, and then 14, 15, 15 and 16, they were kind of the middle of the range for that year, and it ended up marking the low level of 2017. So let's go down and test this 44 level or 42 level and just see what happens down there. That's the big picture on crude. Getting into the last few years, what you see here is we've clearly rolled over. We're $30 off the high, and we don't really have anything turning up yet. This level of $55 has broken, and so we were looking for support. Now we'll have to look for it down around 42, as I said on the other chart. One thing that's meaningful here is to slide this out and notice that in 2000, when the stock market was falling, oil also fell back. In 2008, oil fell back. In 2014 and 15, oil fell back. So it's a good economic indicator of what's going on. And I think what is helpful to notice here is that when oil bottomed in 2016, that's also when the stock market bottomed. So that might be helpful for us as we end 2018 kind of on a sour note heading south. But the bottom line is oil is a pretty good economic activity indicator, and I think the other side of it is some people think cheap oil is good. I would counter that with when oil is cheap, there's usually problems in the economy. So try not to cheer. Let's quickly look at Brent, and on Brent what we see here is same thing. The chart's basically broken. It's 2-year uptrend or 3-year uptrend. It's cracking down now. This 55 level isn't holding, so we're probably going to end up coming in lower here, and there's more support for Brent around $45. We'll see if that ends up being a layer of support. For heating oil, what we see is new 52-week lows. That's clearly not bullish, and same thing for gasoline. I mean, it's nicer for consumers that it's cheaper at the pump, but the real problem is when these two are declining meaningfully, it usually means that there's more economic turmoil. Oilfield services charts have already cracked through the 2016 lows, so with that level of pain, it's going to be very problematic for us to make any real upside momentum. So with that, I'll leave it there, but the bottom line is for the oil industry, it looks tough to end the year.
We entered 2018 with the longest stretch ever on the S&P 500 without a 3% decline. 2017 trading action was the most boring on record, as the streak, as I like to call it, reached 311 consecutive trading days before ending on February 5th, 2018. Just before the streak ended, the one-year simple moving average of the volatility index, or VIX, had tumbled to 11, easily the lowest such average volatility reading this century. Here on the chart, you can see over the course of the past 20 years that the one-year moving average of the volatility index reached the 11 level before starting to uptrend in 2018. Ironically, Fed Chair Jerome Powell was sworn into his role as Fed chief on that very same day, February 5th, 2018. Rising interest rates have frequently been blamed for the increase in volatility during 2018, as the Fed funds rate has been raised 3 times heading into December, with a 4th raise likely. The U.S. stock market faced an adversarial and more hawkish Fed during 2018 for the first time during its 9-plus year bull market run. There were several other dynamics changed in 2018, resulting in increased volatility. In addition to rate hikes, we've had ongoing episodes of the U.S.-China trade war in the headlines, with both countries playing tariff tennis with one another, and that certainly weighed on investor sentiment. The true impact of the trade war can be seen via declining global equity markets. For instance, take a look at the Hong Kong Hang Seng Index, the China Shanghai Composite, and then moving over into Europe, we have the German DAX, all three in bear market territory and trending lower throughout 2018. There's also been an implosion of cryptocurrencies in 2018. Bitcoin, for example, fell roughly 90% during the past year, topping in December 2017 and then dropping down to almost 4 in December of 2018. Finally, we've seen this first simultaneous breakdown in all 5 FANG stocks since the bull market began, with each falling more than 20% into official bear market territory. First, we have Facebook dropping 42% from its high to low, Apple falling more than 30% from its high to low, Amazon falling more than 30% as well from its high to its low, Netflix, perhaps the worst hit, falling over a 5-month period, nearly 41%, and then Alphabet, or Google, from its July high falling 22.4%. While high volatility certainly took a toll on U.S. equities in 2018, the worst may be yet to come. High and sustained volatility characterizes bear markets. During each of the last 2 bear markets, we've seen our equity markets tumble, with VIX readings remaining above key support near 1617. And recently, as our benchmark S&P 500 bounced, this critical VIX support level of 16 held, potentially signaling more trouble ahead for U.S. equities. So while 2 corrections of more than 10% in 2018 have accompanied the return of extreme volatility, 2019 could be the year we truly feel the full impact and consequence.
If you're interested in trading Alexander Elder's Come Into My Trading Room or Trading for a Living book, we have the settings on StockCharts to do that. First of all, the Elder candle style. Then you could use Keltner bands to set up the width. These are adjusted based on the ATR, and the force index, of course, as well as his MACD, or the regular MACD. So here's how you do that. You'd select Elder Impulse System from the drop-down menu on Chart Type. You'd select Keltner channels and pick the width that you want, and it has to be one that fits nicely, and then force index and MACD. And again, the way you pick the Keltner channel width is you want it to just touch the top of most of the primary uptrend bar, so you get out just at the right time. Anyway, enjoy trading for a living.